Welcome to our Voice of Value webinar with Gold Leaf. We're really excited to have Jimmy Marsico from Marsico Capital on. They've been one of our top partners for the last over a decade now. They're Denver based with 4 billion assets under management, and they've been probably the best performing U.S. equity fund in Canada and one of the top funds over the past 3 or 4 years. So again, they're a really valued member of our team, and we've been happy to partner with them for a number of years now. They've been involved in philanthropy, and the family has done a lot in their community and across the United States. So we're really proud to be partnering with them. So I thought we'd have them on the webinar today, and just get their thoughts on the market, how they're seeing things, how they're positioned. And what they're seeing for the market going forward. So I guess we'll start it off, Jimmy, with you guys. How, I guess, top of mind for everybody here north of the border is, tariffs. There's a lot of noise in the headlines. And how are you guys seeing things from the investment perspective? Does it change anything for you, or is it you're sort of just, going with the flow like the rest of us are at this point?
Yeah, no, and thanks for the nice words, and we really appreciate the partnership and have been very enthused about how we've been able to generate really strong returns over the periods. Look, I would say is, despite everything that's going on with tariffs, the new administration, the overall daily grind of what you're hearing with what's going on with the president and the geopolitical issues that are happening, real time, you still have a market that's up. The S&P is up about 2.5% this year. Not to mention, we can get into it in a little bit, just the overall disruption that you saw in the AI trade with the DeepSeek kind of thesis that's been brought to market. That despite all this, you still have a market that's rather resilient. I would say on tariffs, I would have to lump it in with Trump is pretty tough and uncertain to figure out what's going to happen next. But for us, a lot of the companies that we've invested in are ones that kind of have, I would say, decades long trajectories of growth that can withstand, these different issues that can come up. And the kind of growth trajectory that they're on, may have minor disruptions, but the thematic trends that we're investing behind are ones that are rather resilient, that can last through pandemics and tariffs and any geopolitical conflict that occurred. Even if you take a step back to what happened since the introduction of the Ukraine-Russia war, the belief that inflation was going to kind of continue to rear its head. You still saw these businesses, particularly in the growth area, which we like to kind of target, compound earnings at an incredibly high rate, largely as the fact is, they have a lot of top line fundamental growth and unit growth from, tailwinds, whether it's digital transformation, this AI trade, just overall new consumer demand environment improving for new products, whether it's weight loss drugs or any new introduction. So I would say is our fundamental approach of identifying these companies that have high profit margins and high variable costs give us confidence that with whatever's going to happen in the market, they can withstand and grow. And what's interesting is a lot of those businesses I'm talking about are large portions of the market, and they continue to generate high returns despite spending high levels of capex. On the tariff side, I'd be lying to say I can understand where Trump's going to go with it, but I believe Trump is one that wants to protect the border. He's going to use tariffs as a way to kind of get what he wants, but realizing economic prosperity is what's most important. And if tariffs are going to be detrimental to the U.S. economy as well as his partners, he probably won't be that aggressive on it. It's just kind of the first move that he's made. The fact that that happened over the weekend and then he essentially walked it back on Monday just shows how much can happen. But on the positive side, I would say is you're seeing consumer confidence improve here, and you're seeing the unfavorable ratings that the Democrats had. And I think this kind of introduction of Trump, along with Musk being somewhat implemented into the government, shows that we're really going to go after one of the scariest things that I think is out there, which is the budget deficit, as well as the balance sheet in the United States. So they're kind of targeting the big boogeyman. All this doesn't matter if that's not solved. So for them to go and look at the cost structure and see where they can come rip out some of these costs, I think is really, really positive for kind of the long-term trajectory for the market. Could it cause near-term disruption this year? Sure. What's hard is there's still a lot of trajectory going on and good things happening thematically that should likely drive earnings for our companies.
So saying that, are you expecting a lot more volatility over the next 12 months, 48 months?
Sure. Yes. I expect there's more volatility. I think you've had a good move in the multiple in the market. The S&P is trading about 20 to 22 times, however which you want to go through it. So you definitely have had that elevated from the low teens level that you saw in 22 and 23. A lot of the move up in the multiple in the market has been kind of a broadening out that I would argue has occurred. In companies that don't have the same valuation that some of the larger cap component companies that really drove the performance last year. So I would say is there's more volatility, particularly around this belief of the duration of the artificial intelligence investment that's going on, as people are really trying to figure out, is this spend really generating ROI? And is DeepSeek, which essentially proved that you could, build a similar type of GPT model, ChatGPT model with, 1/100th of the CapEx that the US is doing, is that have these companies been spending too aggressively and not getting a return? And have they been doing it inefficiently? And so I think there's a ton of volatility because it's such a sensitive trade, because a lot of the semiconductor companies used to trade at lower multiples before AI, and now you've seen the multiples kind of creep up on there. So if it's proven or the belief comes in that this AI trade is not going to generate new products or be as influential as people think, the valuations could go lower in different pockets of the market.
So
yeah, there's a lot of volatility.
Maybe Jimmy, what is your thoughts on DeepSeek? And I mean, that definitely came out, whether you believe that it truly costed them $6 million, to develop this in China or not, or however many GPUs they actually used or whatnot. Do you think that is, you hear a lot about the CapEx cycle of, even Google came out today, stepping up their CapEx significantly. Do you think, is the market going to start to believe, I guess, that, they don't need to be spending this kind of money? And you see sort of, companies saying, well, why are we spending? Is that sort of the existential question, I guess, on, do we need to be building all this, all this infrastructure out?
Look, $600 billion in market cap was wiped out of NVIDIA after what happened with DeepSeek over that weekend. So clearly, people are trying to discern what actually happened. China has always been very difficult to understand, what's really going on underneath the hood. I believe that $6 million number is likely bogus, that you can't scale up the infrastructure to go generate what they were. Having said that, is it less than, what, OpenAI and Gemini and all the companies here have spent on to kind of get this model going? Absolutely. I do believe that. What's beneficial there is, sometimes being the second mover, you can kind of find different efficiencies that, some of the first mover advantage companies, may not have had. So you can kind of use those learnings. But DeepSeek was trained off of, GPT. So basically their overlying prompts and queries, and I believe distillation, which is essentially just using a model that was already built to, learn on more questions to build your model, occurred. But what's interesting is that they started to limit signups at DeepSeek. and the overall trajectory of performance started to degrade with usage. That, yes, I think they were able to build I would say, I don't want to say a simple model, but in what's being built going forward, it's probably going to be the most simplistic model that AI generates. It's essentially answering queries. So having said that, why are these companies spending so much? And to your point on Google guiding to the fact that they're going to spend $75 billion this year versus $52 billion last year, that's a material step up. And they may not realize a return on that CapEx spend. My argument would be that these companies, maybe not just Alphabet, across the board, have generated the best incremental margins for the last 5 to 10 years in the mobile compute cycle. I think that the level of data that these large cap companies that are spending, close to, $500 billion annually in additional CapEx to go build out AI capabilities, they wouldn't be spending that aggressively if the opportunity weren't as massive. So when Tesla's reporting that Elon thinks he's going to build 7,000 to 10,000 Optimus robots going to 2 million robots, the level of AI needed to go generate, a humanoid robot that could, increase in efficiency across the, any industry you can imagine. And that's a little bit tougher than just building a, large language model. So you have that, you have full self-driving, you have all these new things that could be created. We were looking at just the overall cost of broadband that got delivered back, a couple decades ago. Those costs fell 98% from when they started. With those costs falling, you had companies like Netflix, Facebook, Uber get built on those rails. So yes, I think AI, they're spending a lot now. The cost to deliver it will likely go down. But as the use cases increase, you could likely see the kind of spend levels occur. And what's interesting is, Meta, if we just, click down, they said they saw an 8% improvement in their advertising business overall, their CapEx spend. They just printed a 48% operating margin, despite all that, is running through their P&L and cost structure. And the free cash flow exploded as well, too. So these businesses that are spending aggressively in this new kind of frontier also have existing businesses and, a lot of costs they can take out to fund it. So I would say I believe we're in a relatively Goldilocks scenario, that the dollars coming in are actually generating return on investment through revenue, and they're going to keep reinvesting until it's not the case. And so for Alphabet to say we have the confidence to go out and spend $75 billion next year means that they're seeing signal and improvement across the board. And so I think that this is a compute cycle that has decade plus left, because what AI is going after is a lot larger than most people expect, and what gets built on it is going to be a multitude of the expectations. I mean, we've gone through this before of just when the mobile device and mobile internet, you looked at analyst expectations when it first came out, they missed by a factor of like 60%. No one believed that Meta would have 3 billion people on their products in 2025, 10 years ago. So I think that's where our conviction is a lot of people like to underestimate kind of the magnitude as well as length of these compute cycles. And, this one only got introduced when ChatGPT got introduced in late November of 22. So I think we're still early innings. I'd actually be more worried about it if the companies did pull back on their CapEx spend and saying this isn't something. But given that some of the best arbiters of capital are going after it still, kind of shows like they see it. And their level of data insight is the largest possible. So I'm not trying to give a wide range of answers because it's a daily grind of all the new information that comes at you, like DeepSeek. And you really have to take a step back and think, like, is this what we're investing behind? And you kind of have to look through a lot of the noise to see the bigger picture.
I mean, you've talked about a few of your top holdings and whatnot. I thought maybe you could expand on some of the stocks or companies that you've bought and that have done well, and why, Marsico likes these stocks. So hoping that you can expand on that a little bit to provide a little bit of insight for our clients and why you own some of these positions.
Yeah, honestly, if you want to go name by name, like based off of kind of where you guys are hearing questions, if you want to give me one, I'm happy to go through it.
Let's talk about NVIDIA. That's one of them, but maybe talk about 3 or 4 of the companies that you guys are extremely excited about and love it for a long-term hold, and why, what you guys see. But I mean, everybody owns NVIDIA. Everyone talks about NVIDIA. Maybe we could start with that one, and then maybe take the next top 3 or 4 companies that you're the most excited about that you currently hold.
Great. So look, in terms of NVIDIA, I think kind of where I was going of people are trying to estimate what data center demand is going to be, data center revenue is going to be for that company. I think DeepSeek definitely caused a lot of consternation about NVIDIA's growth trajectory. I think 25 they feel okay with. It's what does 2026 look like and 2027 look like? So after the reporting for Meta, Microsoft, and Google, the fact that they're taking their CapEx up, I believe Microsoft said half their CapEx goes to data center build out, the other half goes to semiconductor spend. You'd actually have a lot more confidence in the fact that you could see growth for the NVIDIA data center business going forward. I think there's a bit of a handoff as you're moving into their new product around Blackwell and launching that and getting the supply chain and getting the yield correct there. That could cause a near-term disruption. So you've actually seen the multiple on the business compress to, I would say to about a market estimate around, the 20 times earnings. If you go back and look at what you were paying for, the pets.com or some of the different models in the internet hype cycle, they weren't trading at real earnings like NVIDIA is. So I could see that there could be a potential disruption here in the next couple of quarters, but no one has come with a competing chip to market. You've seen the problems that AMD's had to kind of catch up. So I think NVIDIA has really generated such a competitive lead and should be able to step on the gas as you look to the out years, mostly because our belief that it's generating a positive return for the companies and there's no alternative. So it's going to be tough to disprove NVIDIA's importance and longevity when their next peer is years away. I think one of the things that could give you fear is that these companies are going to be tired of spending on someone else's product and will look to do so internally, which is why you could have a positive thesis around the other infrastructure providers around I would say the picks and shovels for semiconductors. Broadcom is a company that comes to mind, particularly with the custom ASICs chips that can be developed. So in whole, if NVIDIA was trading at a nosebleed multiple, you'd be nervous. You'd be much more worried about it. Here, I think there's a good line of sight to consistent earnings for the next couple of years, as well as maybe the potential to accelerate on the out years as the level of spend becomes so important to generate these new models and new opportunities around AI that NVIDIA is the main player. And Jensen is, again, we really try to focus on those companies that have best-in-class managers. Jensen is a guy we are very comfortable underwriting to invest behind. Gosh, where can I start next? I think Netflix is a story that we really need to touch on.
Okay.
The Netflix was in a dogfight with companies that were spending aggressively to acquire subs and enter into the streaming market. All the while, Netflix stayed true to its knitting and really just kind of stuck to what they did best around the best-in-class user interface, adding additional content but not overloading it, and really not stretching itself. With the rise in interest rates and what you saw in 22 and early in 23, where it created a hurdle to investment, those companies that didn't have positive unit economics and were just spending to just acquire top line subs, that went out the window. And so Netflix, as a result, was able to withstand that and became the sole survivor. And when you're the sole survivor, you can start harvesting the fruits of your labor. So you've seen their ability to take pricing up, as well as drive subscribers, because they're the only model that really is generating benefit to the consumer. And what I'd argue still is that they have an advertising business that is yet to launch. We think that is something that is really attractive and interesting leg to the story, particularly as their investment in the NFL games. This partnership with WWE is very interesting. And this move towards live will really show that they can tip the scales and start generating meaningful advertising revenue. And what's most interesting about that is a month of the advertising plan on Netflix is, I believe, is $8, maybe a little more. If you look at the relative spend of what you get for $8 versus, even going out to, dinner and a movie, that's like 10x. I mean, it's 10x. So we really think there's a lot of room for Netflix to take price, given the alternatives just don't give the economic benefit and enjoyment that Netflix has. So we really think Netflix is a strong core position. No one would have believed that they could grow their sub base by 19 million in the quarter. But it just shows the level of execution and, their ability to drive down costs, and, should be able to have them, keep increasing their earnings, strong free cash flow, and we have a strong capital return program. They've been buying back significant amount of shares. It's a story in which when we first owned it, there was fear about the multiple being too high or their ability to grow into it. And that management team, as well as consumer proposition, showed legs. So, it's one that we continue to have a lot of confidence in. It's actually, one that's easier to sleep at night with, which is what we kind of look for. Let's see where else we can go. Similarly, I think that it'd be hard not to call out this TKO. It is a newer ad. The position is really instituted on our belief that this company that traditionally delivered its content on linear television models would gain attraction to have these streaming businesses want to acquire the rights to show their products, which is the WWE World Wrestling Entertainment and the UFC Ultimate Fighting. The belief there is that live sports is the only way to really generate, user eyeballs. And so Netflix partnering with WWE to take their Monday Night Raw flagship program to go global kind of showed its hand of, hey, we need this. We need this type of content to create this type of engagement. And then, yes, it's not traditional sports, but, you're getting it at a relative value. So the traditional viewership on a Monday Night Raw show that occurred on USA Network domestically was about 1 million people, 1.5 million on a Monday. The viewership that the first Netflix show that Raw had was about 5 million. And then they actually saw global improvement for people outside the US that streamed that Monday Night Raw show the following day because they were likely sleeping. So even if that number degrades down, you're seeing a material step up in engagement on that product. And their most recent pay-per-view, which is the Royal Rumble, they saw a 94% increase in sponsorship revenue and goods that were purchased there as well. And it was the largest gate with 70,000 people attending, which had prices increase as well. So the overall halo of moving to a global distribution platform in Netflix shows that it's an important vehicle for Netflix, but will amplify that business. And what's interesting is the UFC, which is the other leg of the business, has their rights negotiation coming up. They were with ESPN and Disney, that the rights negotiation will be coming up, and we think that the licensing fee that they could garner from any potential streamer or Netflix will be potentially 2 to 2.5x what they were getting paid, which is incredibly incremental to earnings because you're not spending more to deliver the content. You're just getting paid more because it has higher value. So it's not a traditional name you would think, but our kind of overall thesis about digital transformation and content delivery that we've invested behind, we identified TKO as one of these companies that can really benefit and really go forward and drive long-term earnings power, and the thing will generate a ton of free cash flow, and we think it's really attractive. What's nice is, to your point on volatility, it doesn't necessarily fall itself into the daily AI trade or tariff trade. So finding those businesses that you can get comfortable with are where we kind of look to do so.
Jimmy, what areas of the market are you guys avoiding? I know, in the past you'd own, healthcare names like Lilly, and are there certain areas that you think, are you guys are just kind of stepping away from, or what are you avoiding sort of this year more than anything?
I think healthcare is very tough. I think staples have always been very difficult because it's just X growth. I think financials is an area that you hadn't traditionally seen, but back to kind of where you're looking at, I would say, potential economic improvement, consumer confidence, in a more favorable interest rate environment, economic environment, you can get comfortable with the banks here and financials and private equity. The M&A cycle in overall, I would say, locked on deals that could have been done in the previous administration, the FTC, really kind of hand-tied a lot of these businesses. And so our belief is, we think it's a more accommodative environment for the financials to really deploy capital, and believe that the M&A environment is going to really improve here as well, which generates more transactions, really just helps kind of the overall investing trajectory for the likes of Goldman, JP Morgan. We can look in the private equity space on the KKR, Blackstones of the world, that I think those are names that are actually pretty attractive. The rate of change of what you could see for those businesses is I think a little clearer than it had been. So I think that's one area in which you could see us add a little bit as well. Because likely if you look at the composition of the portfolio, we really benefited greatly from identifying the AI trade and the kind of infrastructure building trade. That
to put it lightly, yes, I think you did benefit from that. Yes,
I don't want to say it's seventh inning because I don't believe that, but it's not first or second inning anymore. And if it is, we're still positioned there. But I think incrementally you'll see us look across and find those names that are either in different parts of the market or those businesses that benefit from the infrastructure that's getting built. Even look at even if you look at the restaurant space or just overall any consumer business, the efficiency that they can go see by implementing these tools, which should go down, like you could see material improvement. Like a company like Chipotle, throughput in figuring out where to source your food from and how much to buy and how many people to hire and when should they be having the most people on the line. Like, how do we come up with a better way to reposition a new store that's built? What does our app look like that we're delivering to the consumer? Like, if you think about the knock-on effect of what they can use from the learnings of AI, just how much improvement they can have, you could have efficiency just be the biggest driver of earnings for a lot of these businesses. If you think of a company like Tesla, he's been able to drive the cost of a car down to $22,000. And he's seeing a 10x improvement on his full self-driving with his AI spend. Like, that's incredibly disruptive. And if you think about what that leads to, he can essentially lower the price of his car to get at parity and suck the air out of the system for everyone. So I know I jumped from financials to Tesla, but the overall movement of magnitude of, if they're going to spend this much on these chips, you need to open your mind to what could happen to the improvements that you can see. Because I argue you're only seeing efficiency in a lot of these businesses, whereas the revenue opportunities are just starting.
Can we talk about Elon Musk for a little bit? Because if I'm not mistaken, when we met with your dad, and Jim, I think you were there as well. I think your dad was you and your family were one of the, I know you know Elon Musk, and I think you guys were one of the very first investors with him as well. So love him or hate him. What do you think of Tesla? Where do you think with the robotics and all that stuff? Like, are you excited about this? Is it high on your priority of a company to hold for a long period of time, or is this a company that stay away from?
We've followed Tesla since the IPO. We had one of the very first Model S's. I think I visited a factory. I visited the Gigafactory here in Texas 3 times, Fremont maybe 4 or 5 times, and I've been to Nevada to visit the factory there, and have had countless meetings. And the overall ability for that business to get from where it was in building a car to producing it at such a low level now speaks to the pure rigor and genius that he has. His level of efficiency to do something that was horribly complex, to distill it down to decrease the amount of parts in the car and the amount of space needed at a factory, is really hard to deny. The supercluster that he built in a matter of months surprised even Jensen. So his ability to innovate and move is undeniable, and is probably best in market. And you've seen the fact of, even the mention of the tariffs. The traditional car providers can't deal with that. They can't raise the prices on their cars because you're competing against a Model Y, which is the highest sold car on the market now. A Model Y where you put a couple of $1,000 down and pay $400 to $500 a month to get the best software in a car that can drive itself is, pretty tough to argue against. So I think on Tesla, our belief is that the auto business has sucked all the air out of the room, in that the relative choice that the consumer has will move towards Tesla. Full self-driving is also something that I don't think has been fully understood by the market. A lot of the time, mostly because people haven't used it. It is transformational to be able to have your car drive yourself. And even on the earnings call, he is pleading for people to just try full self-driving. And what's interesting about full self-driving launching is the amount of time spent in your car, concentrate on the road and, white knuckling it, making sure you don't get in an accident, to where you could actually just be on your laptop or watching Netflix or, doing whatever, just creates more engagement that's occurring on a device. And his device is going to be the one that's left. So we are very, very bullish on where the auto business can go, as well as full self-driving. I think robo-taxi is an interesting market, but one that he doesn't have to win. Waymo is a good competitor there. the overall thesis of just car ownership is frustrating to have. So if you don't have to own your car and there's a transportation network that can get you places seamlessly at a low cost because you don't have a driver, is very interesting. I don't think robotaxi is something that is that necessary for the overall excitement around the name. And then, look, Optimus and robotics could be his largest market. On the call, he was saying that he should get to 7 to 10,000 by the end of the year. He said the robots are working in his factory now. And he said the robots are doing jobs that no one else wants to do. And if you just think about how deflationary that is and impactful that is on the overall margin trajectory for that company, that if he's producing a like a $30,000 car, let's say at a 26% gross margin, if he's able to lower his input costs and his people costs by just having, robots that can work all day,
Yeah.
you really have to think about it. I mean, it's scary for the environment for a lot of jobs, which we could talk through, which is, I think a bit of an issue longer term. But Optimus itself in a manufacturing capacity should sell a significant amount of units. And he said, and sometimes you can take him at his word. A lot of these things don't happen until, a lot later than he says. But if he said that he can deliver, once he has a run rate of 2 million robots being produced, the cost of that robot is going to be lower than what it is for the Model Y. And the price of that robot will be different than the car. His argument will be the market will set the cost of that robot. So if you have to look at, either the consumer adoption of what the robot can give you or what it can have to help your enterprise, it's likely a lot higher than what you're paying for his Model 3 and Model Y. So Optimus would be margin accretive to the business longer term. When does this happen? Probably in 5 years. I don't know. And that's a little bit of the exuberance in the stock and why it gets a hefty, multiple of, I think it's 30 to 40 times EBITDA. 70 times earnings at the moment. But, like Netflix, his ability to prove out that those earnings are much larger than people expect in the out years is why you can have comfortable owning the stock. On his involvement in the government and everything going on there, that's one of the things you have to deal with investing in Elon. People complained about he bought Twitter. He's constantly on there. He's just a dynamic personality that, isn't as easy to get comfortable with for a lot of people. But what's interesting is that personality and how he presents himself leads to the Tesla business not having to spend that much on marketing dollars to introduce new products. His Twitter following alone, and when he launches a new product, achieves what, a Super Bowl ad is for a GM car probably daily. So, he definitely is not the easiest at times. But if you take a really big step back, he's undeniable. And then if you look what he's doing on SpaceX to, disrupt something that hadn't been disrupted for, since, inception for NASA, no one else was able to do it.
What do you think about Neuralink?
Neuralink, I wouldn't be the first one to try it out. I don't, I think Neuralink and the Boring Company, where they're building the tunnels, are side projects that he enjoys doing. It shows just the breadth of which he has curiosity and bandwidth that he has. I do think his focus on the U.S. government and DOGE is very, very interesting and very, very bullish. For them to go through sector by sector of where there's bloat and spend within the U.S. government, this is the same guy that can produce a 25% gross model car on as I mentioned, on a $30,000 ASP. if he can go look at some organization like the US government and find inefficiency, their ability to take out costs and reduce the deficit, as well as potentially, grow top line as, some of these regulatory hurdles move away. I think you can get really confident that he's in there and he has people in there. The talent that he attracts is also, something to really talk about. There's tens of thousands of people trying to sign up to go work at Tesla or SpaceX, or just have any bit of, ability to work for Elon. That if he's attracting that talent to the government jobs versus, what had previously been going in there, and you can make a change, you'd feel very comfortable with what's going on there. The daily news about everything that's going on is really, complex and frustrating to deal with as you watch stocks trade daily. But, as a whole, I feel pretty good about it.
Jimmy, with Doge, what kind of savings do you anticipate, and what sectors are going to be hit negatively?
Oh, gosh. I mean, you could argue that he's going step by step, right? You've seen them take out a few programs already. The Department of Education he's going to go look in. I think the Department of Defense is likely one where he'll look at. I think the defense contractors, they mentioned the F-35 program, of how bloated that is. I can't speak to the magnitude of how much they'll save, but he commented on a chart that we could potentially get to levels of spend of like 28 to 2019 levels. Whereas in the previous years, in the previous administrations, you've seen a material gap up in overall costs that have been occurring within the government spend. I would say, programs that are occurring outside the US are likely going to be the ones that are really impacted as well.
Do you think this is a precursor to another tax cut like we saw in like 16, or do you think this is just strictly a, cost structure takeout, as you put it?
I think there's cost structure takeout. I think the goal is for President Trump is to improve the economic environment for his citizens, as well as the safety of his citizens, right? And he wants to go achieve that. They've talked about somehow trying to eliminate property taxes or, federal income tax already. You can't really do that if you have that much level of spend. So the first thing that needs to occur is they really need to look internally of where the inefficiency is and what they're spending on, and go after that first. Could tax cuts and, a more accommodative environment occur? Hopefully. I think that's why you're seeing a little bit of exuberance in the market of, people are just generally feeling a little better about the trajectory of the country. Inflation still is there. We'd argue that inflation is going to continue to come down, particularly as shelter, which is the largest portion of CPI, starts to come in. That still has been rather pesky in the mid-single digits of growth. It's an overall third, as I mentioned, of inflation. As those come down, because if you look at anyone who's renting an apartment, there's no growth there. You're actually seeing discounts and lower rates in that shelter space. It's just a delayed. It's a delay that you see in the reported numbers, because leases just don't get signed every day, and it's the way they collect the data is also a little flawed. Overall, the trajectory of inflation we think will go lower. And the next question is, won't tariffs cause inflation? Potentially, but if they did, he'd roll them back, because inflation is detrimental to asset prices, and he wants to have a healthy market and environment for his country. So inflation doesn't really help anyone. The only argument you could say that inflation essentially helps those that are holding cash. But
I know we're getting close to the end. Can I ask one question, Dave? I've been following it of late. I've been watching it for the last 2 or 3 months, see what's going on, trying to get my head around it. But are you guys following quantum computing at all? I know a lot of people don't know what that is. So maybe for our audience, maybe it'll be the first time they heard it, but I'm not sure where you guys are at. And we've never had this conversation yet. So I'm just curious what your thoughts are, if you guys are even looking at that stuff yet.
The only Jensen came out and said that the impact of quantum computing is less than people think, I believe. And then, I
Yeah.
believe Gates came out and said the reverse. And so the fact there's stocks traded at that level it's too far outside of our purview to really think about investing behind. Do we think about it? Sure. If you go through and read about what quantum computing is discovering in the supercomputers, they're actually understanding, the way the universe was created. So I think it's kind of interesting to just, be theoretical about, but in terms of the day-to-day, the overall understanding of where this AI spend and trajectory is going is much more interesting. For everyone listening out there, I encourage you to just use, ChatGPT or Perplexity, its product. ChatGPT has launched this, it's called Deep Research, where you can ask it questions and it, basically thinks for 15 minutes and then generates a report, that's like 3 to 4 pages. For instance, I asked a question about Starbucks being able to double its store count because Brian Niccol said it on the call. And I was like, I asked it, what's the feasibility that Starbucks can generate its store count? And what it gave me was it went state by state in the US, look at the amount of population there and the amount of existing Starbucks that were there, and then inferred how many, what saturated markets there were, what unsaturated markets were there. It also then looked at different areas and regions in the country where competition was high, like Dunkin' Donuts was there. And then it inferred to try to help me understand that, what, if that was able to be achievable. The level of data of input and even writing that report would have taken, I would say, a junior analyst a week to deliver to me. And that delivered in 10 minutes. So at the moment, we're really only scratching the surface of, what this can do. We were talking today, I think the biggest, risk that I have is I'm not asking it enough questions. I'm underestimating, what it can do. And so to think about that AI spend, and if it's being justified, that analyst that we used to have now costs $200 a month and works a lot faster, doesn't need a desk, doesn't need real estate footprint. And my efficiency and our efficiency to move fast as a firm has only improved.
How do you know that the information is accurate? That's the only concern I have. How accurate is the data you're getting?
I think it actually shows you the sources that it's using and as it's thinking.
Right.
I'm sure there's some inaccuracies, but there's also human bias when you ask a question too.
Correct. Fair.
We can go back and check, if it is accurate. Like if you were to ask me to write a, market summary, A, it could write it for me. B, it still isn't at that level of, being that, matter of fact and that accurate, I would say. But it's only been happening for a year or two.
Right.
What does 8 years look like out?
Right.
And so I think that's into the DeepSeek question. They built that kind of their model for cheap, but it's essentially table stakes of what it does. What I just told you on that deep research, took 15 minutes to produce that type of output. Sorry, my camera. The level of spend that you need to go do something like that on the inference side is much higher than the training. So the duration of the AI spend and the capital spend is likely a lot larger than what you've seen so far. So our belief and my belief is you're going to continue to see CapEx go up because these companies are finding efficiencies and new models that are going to be built. So yeah, again, Google saying they're going to spend $75 billion, I thought was incredibly positive across the board.
Great.
Jimmy, thanks. Thank you so much for being, first off, a great partner, supporting us with our clients. We appreciate you taking the time today. I know you're a busy guy, and Winston for setting it up. I know that our clients will enjoy the video and probably have a few questions that hopefully we can throw your way at some point. And again, appreciate your time today, and thank you very much. It's been very helpful.
Yeah, no, I really appreciate it. It's enjoyable to talk through it. I know it's funny, your mind can just go any different way at the moment with all that's going on the geopolitical side, as well as different signals in the market. But that's where we thrive. Our curiosity and wanting to go discover what these new step function changes are occurring and who it impacts is what we do. There's someone asked me, when, what are you doing your day off or whatever, and it's so tangible. It's enjoyable to talk about and think about. My daughter was asking me questions in the car on this morning that I would traditionally be like, I don't know the answer to that. But then, my car was driving myself, and I went to my phone, went to ChatGPT and asked the question and gave me an answer seamlessly. So I think about, you think about what that impact was of just how much more can occur if you just ask the question and think about what that leads to. Hopefully we can find those companies that benefit. I think our ability to identify those as well as hold on to them, and the fact that we take concentrated bets is where we really do well. And also the structure of the firm with the research team being, constrained to just 5 of us, we have a ton of agility and are willing to say when we're wrong or press when we're right, versus I would say, competition that, there's a lot more layers that people have to go through to get a position established. So, we really track our companies. We do a ton of deep research, both on the themes as well as the individual models, because it's our passion, and delivering good results is, where we feel our best. So we're going to keep doing it for you guys.
Appreciate that. Your outlook is positive. I think a lot of people want to hear that, right? And I think Ryan alluded to the fact that there was some negative sentiment in Canada, but certainly your outlook and some of the information that you provided is extremely positive, and how you're taking advantage of the opportunities that are going to exist going forward. And for that, we appreciate
it. At this time last year, people were calling for a recession and risk around the election and inflation and all these different issues, and didn't believe the market was going to return more, I think on average, than like 2%, 3%.
Yeah.
They underestimated the ability for these companies to grow and the environment. So I believe it's really easy to get negative. When DeepSeek came out, I was like, AI spin's over. But when you actually then go pull back and, look underneath like all the different bias, and then go comb and just kind of go through the different research outlets, and it's what's fun. So I would, we remain positive. It's not popular to say so, but we really do. And then in terms of other areas to invest, I think that the stock market and a lot of these companies that we follow really are kind of the best in class that can generate, good returns versus different pockets. So, as there's a lot of cash on the sidelines, as rates come down, we really think the equity market will remain attractive, which leads to an upward trajectory for returns.
Perfect. Again, thank you very much. And we'll call on you again. Hopefully you'll have some time for us. We really appreciate it.
Ideally not, because there's something crazy going on. But that's probably going to happen, and I'm just going to keep saying the companies are going to keep doing what they're doing, but that's it.
No, we do appreciate it. Again, it's been a great partnership, and thanks for all your input. We should also, Ryan, maybe just talk about the Marsico growth. What was the return last year, just for our audience, so that they know the return? I think it was fairly high. So maybe just share.
I believe the U.S. growth, and don't quote me to the percent, but I believe it was 68 in our Canadian dollar terms. So I mean, it was. I know for a fact it was the number one Canadian U.S. or U.S. equity fund in Canada last year. So
And how
it
about the
just
year
speaks.
and how about the year before that?
Yeah, I mean it's in the top 5% or 3%, or I mean we're talking the best of the best here. So it's been an excellent partnership over many years as well, not just the last two. It's the performance has been there.
I think that's the key, Ryan. It's not just the last 2 years, but we've been with them since 2008, and they've been there each and every year. So again, it's been a great performer, great family to deal with, and great results. So again, thank you on behalf of not only for the Marsico folks, but to all our audience and our external family for trusting us and having the confidence in their financial affairs. So thank you, everybody.
Thanks.
Okay.
Guys.